join us, everybody, for Tuesday the 4th of August's daily market wrap. Let's kick it off with a bit of the ISM manufacturing PMIs coming out pretty strong overnight. Jack, what was the movements from that?
Yeah, definitely came out a bit stronger than the market was expecting. So there was big movement in the manufacturing sector, sort of growing at its fastest pace in the past 4 years, which caught the market off guard a bit. And what that's done is it's supported the US dollar, which took a bit of a beating last week with the divided Fed, sort of really pulling that the dollar down, and the dollar index was below 100 towards the end of last week. And this sort of manufacturing data, the strong data's given that a bit of support, and it's now sitting about 100. The USDX. So.
Yeah, really rested that the slide in the USD across all the pairs, didn't it?
Massively.
So that's probably good for the US. And the yen, a bit of volatility, or a bit of stability after the recent volatility from the end of last week. Just talk us through what happened there.
Yeah, so there was a huge move in the yen last week as the US and the Ministry of Finance in Japan coordinated to intervene and support the yen. So they propped the yen up, caused a 400 to 500 point drop in the dollar-yen pair, which was a massive move, and caught markets a little bit off guard. I guess they were suspecting intervention for the last few weeks, but it probably got beyond a point where people were expecting it to happen, so did catch them a little bit off guard. So there was a lot of movement there. And then on Friday, the Bank of Japan also had their rate call, where they held at 1%, but indicated that a rise next meeting was more than likely.
Yeah, and the US has set up the facility for foreign borrowing as well. Set at $60 billion, which, if anyone doesn't know, foreign entities can borrow up to $60 billion of US treasuries. So effectively, it gives a second wave of attack for Japan to start selling the dollar if they need to. They don't have to actually use their own treasuries to sell off, which helps the US rates, and also effectively gives them as much dollars as they need to actually push the market. So I think 2024, they used about $36 billion or something like that to send the market 500 or 600 points. They've got their own money plus a $60 billion facility, so they've got two waves now. So markets are now sort of second guessing whether or not this could be new, or whether or not they could keep the dollar yen pumping higher. So we'll see what happens over the next week or two, I guess, from this now.
Yeah, for sure.
And US equities, another big day.
Yeah, another solid day. Again, bouncing back after a poor finish to last week. But it was more just a sector-wide sort of uplift rather than the AI-driven story we've been talking about the last few weeks. So yeah, just people rotating back into a risk-on mindset with the tapering geopolitical tensions at the moment.
Yep, cool. And the rotation, is it out of the AI stocks elsewhere, perhaps?
Yeah, I mean the chip makers were all pretty flat. So yeah, not much movement. So I guess any free cash people had rather than rotating the chips were into the retail sector, mainly in the consumer staples.
Cool. And not much out today. A bit of a light on today, and looks like NZ tomorrow, which might do a bit, but I guess the services is a big one for the coming week. So certainly after last night's strong manufacturing data, we'll get the services side out of the US tomorrow, so that'll be a key one to watch. But yeah, today the market will sort of hopefully take a little bit of breath, unless Trump comes out with something special. We'll see. He likes to do that over the weekends though, doesn't he?
So.
All right, big movers. Pound, 0.4%.
Yeah, so we saw, again, this is driven by the manufacturing data, giving the dollar an uplift. We saw the pound make some pretty big gains last week, both with their hawkish Bank of England rate statement, where they had three of their officials pointing to a rate rise, which was more than expected. So they've got a hawkish stance, which boosted them up. And then with the Fed sort of wavering a bit, obviously the dollar declined. So the pound dollar was increasing last week, had a strong week, and this manufacturing data has sort of pulled that back a little bit, but it's still higher than it has been for the last couple of weeks.
And the Dow marches on.
Yeah, as we said, a solid day for the US equities. We can see the falter sort of on Friday, but yeah, it was sort of marching up and finished at a record high last night.
Palladium, what's happening with the metals here?
Yeah, palladium, just one we don't often talk about. It's a very price sensitive metal. So 85% of the demand for palladium is in catalytic converters, which is in petrol combustion engines. So obviously electric vehicles becoming all the rage, demand's growing for that, which is sort of dropping down the demand of palladium. So it's a very supply-demand driven precious metal. So there's a lot of factors that play into it. The key miners and exporters of it are Russia and South Africa. Both contribute about 40% of the global palladium levels. So we saw during the start of the Russia conflict, the price got to about $3,400. It's now sitting at about $1,250. So you can see how much the supply demand drives that. Yeah, and platinum is used as an alternative to palladium, so they're very intertwined, those two, so a lot of volatility on that front.
Cool. And the vol, silver?
Yeah, you can see silver, it's been bouncing up and down recently, sort of range bound, bouncing up and down between the two, but I guess when you take the average out of it, the price has been relatively flat. Market's still sort of waiting to see what's happening on the Middle East front and what way it's going to head.
Yeah, a lot of mean reversion around that. And dollar Swiss, chart of the day. What's brought this one on?
Yeah, dollar Swiss, we can see the gains it's been making this year. Obviously, both the franc and the US dollar are safe haven demand currencies. So with the Middle East conflict, obviously investors flock towards these safe havens. But what's driving this is really the carry trade with the rate divergence. The US rate is currently at 3.5 to 3.75%, holding, potentially looking to increase, but that sort of wavered the last week or so. Whereas on the Swiss front, they're at 0%, and the SNB, their central bank, has come out and said they'll actively weaken the Swiss if they need to keep the demand there. So that carry trade is basically driving this raise this year.
Cool. And the article day, a bit of propping up of the yen, probably a very good one to read to kind of understand the dynamics about how the treasuries and the currencies work together.
Yeah,
so
this will really break down last week's move and what to look for moving forward.
Cool. Yep. Nice one. Any questions, anyone?
Yeah, Jack, before, I think you were talking on the first slide, you're talking about the risk on mindset.
Yep.
How do you know that's what's driving the growth?
Yeah, well, it's...
Talk a little bit more about that.
Yeah, so equities are a heavily risk-affected asset class. And so when buyers have got confidence in the market, they'll pile into those riskier assets because these companies are sort of heavily dictated to by broader economic conditions. So when the geopolitical tensions, primarily at the moment out of the Middle East, come down, when oil comes down, it gives investors confidence to move and rotate into those assets rather than protecting the dollars, which are potentially at risk. So when we're talking about risk on, risk off, that's sort of what sort of the catalyst for that mindset, and then what it means for an investor's money. Do you want to add anything to that, or?
No, it's not really. I mean, like it's obviously in risk times, like if you look for something risk-free, you tend to go for US Treasuries. If you want more risk because of the capital protections that are built into the products themselves, you tend to go for equities because you get capital gains, you get a bit more yield in it as well. So they're riskier assets because they offer less protection than, say, the US Treasury or any government sort of bond, or even any big sort of like, say, Mag 7 like debt or bond or something like that. So it's a riskiest asset in the capital mix.
Yep.
Because you're offered the less protection. If there's a default, you get paid out last, effectively as the owner of the business.
Yep.
So that's what makes them riskier. And that's kind of, when you see equities go through, that's kind of what they mean by the risky asset part of it.
Thank you very much, everyone.